Hi everyone. In this part of CFA series, we are going to explore more about the dynamics of collateralized lending, and we'll explore more of equity shares as a collateral, both from the perspective of lender as well as the borrower. Let's see more. And here, if you see, we have two options. One, equity shares of borrower, which is primarily the entity to whom we are lending. And the second option is equity shares of the other entity, which is not related to borrower. Now let's evaluate these two options completely. So when you are lending through a collateralized loan, collateralized primarily by the equity shares of borrower, which means that your exposure to the equity risk to that borrower is very high. So remember, you are taking equity risk in the guise of credit risk, and therefore this option works out well only when you have, number one, thought on that the equity shares prices are going to increase, which means there is a potential upside. Secondly, it would work well when the yield is high on these lending. However, in most of the equity shares collateralized lending, the yield is typically low. So this doesn't work in this case. Now let's see what are the risks to this particular option. The risk is the correlation is very high. So you have lent to a borrower which is collateralized by the equity shares, and therefore if the business goes down, number one, it will not be able to pay or service the debt through profitability. Number two, since the equity shares prices will be correlated to the business prospects, the collateralized value will also come down. So the correlation is very high to the existing business, and therefore this is a highly risky proposition. Now let's look at the second option. So second option is equity shares of other entity. Now what happens here is, of course, you have lent to a particular borrower, let's say X, which is into, let's say it's into a paper manufacturing. Okay. However, you have got a collateral for another firm, let's say, which is into steel manufacturing. Now, typically, in order for these transactions to happen, the promoter or the borrower needs to have multiple lines of business through which he can provide collateral for another business for this particular lending. In this case, the correlation is not there. Since the correlation to the existing business is not there, at least I would say this is much better than the option 1. Now let's compare unsecured lending, lending against equity shares of borrower, and lending against equity shares of other entity. So unsecured lending is primarily when the yield is high, the return is high. Of course, there is no security, and therefore you have to primarily rely on the cash flows of the business. And it is a call on your perception of how the business cash flows and the business strength would evolve over the period of lending. So that's primarily unsecured lending. The risk reward, so the reward is higher yield, and the risk is, of course, it's totally unsecured. In terms of loans collateralized by equity, so here the yield is not that high. Remember, the borrower is entering into this option is primarily because he does not have sufficient resources to service the debt in the initial period, and therefore to enter into this transaction, he's bringing more equity as a collateral. So the yield will be low, the potential upside is high, but as we discussed, this is a risky proposition. If you think that the business has some idiosyncratic risks and is very vulnerable, then this option is not recommended. Now coming on to the equity shares of other entity. So of course the equity shares of other entity is a much better option what I would say is the lender should evaluate whether he can actually give an unsecured loan to the entity for whose equity shares are being collateralized. If my answer is yes, I can lend on an unsecured basis to this entity on an independent basis, then this is a much better option. Why? Because the lender will enjoy some sort of equity upside built into the structured transaction, and the risk will be much lower. So if I have to generalize or rank, then I would say this is 1, this is 2, and this is 3.